Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate and infinite banking expert Jason Henderson. Jason is an experienced real estate investor who has mastered the powerful strategy of infinite banking and has used it to accelerate and compound his wealth as a real estate investor. Jason is also a published and best-selling author of Master Your Millions, which can be found on Amazon, as well as the host of the popular YouTube channel Master Your Millions. Now, in today's show, guys, we're gonna dive deep into the infinite banking concept. You probably have heard of it, but specifically in today's show, we're going to uncover how this concept really transformed Jason's perspective and overall investment strategy. Um, you know, More specifically, we're going to discuss how using properly structured life insurance policies to build cash value can then be leveraged to finance your real estate deal. So again, this is a real estate podcast. We're going to talk about investing in real estate, but by leveraging the infinite banking concept. And so with that, guys, I'd like to welcome Jason Henderson to the show. Jason, my friend, how you doing today?
I'm fabulous. Thanks, Kevin, for having me on your show.
Yeah, thanks for joining us. Excited to have you here. And this is a topic that I think we've covered maybe many years ago, but it's one that probably some folks have heard of, some haven't. Many who don't fully understand, even those that have heard of it. Like I'd mentioned to you before we start here, I have a general understanding of the infinite banking concept. I know the basic framework of it and the power behind the strategy, but I do not utilize it myself in my own life and my own wealth creation. And so excited to dive into it here with you today. And so maybe we'll start here, Jason. For those that aren't familiar with you, I gave you that brief introduction. I know there's much more to your story and your background. Maybe take a few minutes and just tell us a little bit more about yourself and ultimately how you got into this world of real estate.
Okay, great. So I came from a large family. Grew up in a small town in Idaho called Pocatello. Was the youngest of nine kids, and grew up real good. My having been the youngest of nine kids, of course, my parents a little bit older. In fact, my dad was a veteran of World War II,
Mhm.
and when he came home from the war, he and his four brothers, there were five of them that were in the war together. My grandfather wanted to have everybody together, right? And so my dad didn't go on the GI Bill. They started a sawmill in central Idaho. Fast forward a lot because that turned into lumber planing, a lumber company, and they started building houses themselves, right? So he got into real estate. When I'm to be born, my mom drives to a place where he was on the roof, finishing the roof of a three of six, um, six, three sixplexes in a U shape, right? And he's up on the roof. She goes, "Hey, I'm having contraction. You come to the hospital, or yes or no?" So he's still in his work clothes. He gets down, he goes in, comes to the hospital. I'm born. Not too many years after that, he and his twin brother that were building that using their own lumber that they had cut and everything wanted to buy that cash flow cow really for him. And they said, okay, yeah, well, they sold it, but they carried the paper. They were the bank on that property, right? And for the next more than 30 years, because it got sold one more time, dad got a check every single month for that mortgage payment. And it could go years without him going by those properties. He didn't need to, right? He was simply the bank on that.
Mhm.
And for a lot of times, my brothers and I would think, how do we do like what dad did, man? That's kept passive income, right? Because when you manage or you own real estate, a lot of times you have a manager that you're actively paying or you're doing it yourself. I mean, you're going changing the toilets, resetting them or fixing some sort of plumbing or doing some sort of whatever, right? Well, as I got through school, and because my dad always wanted me to go to school, get a good job type of thing. And so I got a PhD and I'm done and I'm working out and I start reading books and understanding things. I said, wait a second, I should be doing what dad's doing, not what he told me to do. And so I started to get back into real estate. And I have two brothers in particular that had been pretty heavily into real estate. And I started begging them to let me get into it with them. And then I came across the book, Becoming Your Own Banker by R. Nelson Nash. And it completely changed the way I think about it for the fact that I could now be in the position that dad was when he carried paper on that real original 18-plex,
Yeah. No,
right? And just collect that for a long time. And he did. It was over 30 years that he collected that check. It was pretty amazing.
Yeah. Yeah, no, and I appreciate that background, Jason. And yeah, great sound principles that you took from your father and your parents, and ultimately have leveraged it into something even bigger today. And so what would love to, you mentioned Nelson Nash. I know that he was I guess the original author of the book that really made this a little bit more of a commonly known strategy. Still not all that common, but more commonly known. But it's been a concept that's been used by wealthy families for centuries, correct?
Correct. Yes.
Okay. Maybe let's start with the basic foundation of it. Infinite banking concept. What is it? Just, broad spectrum for those that have never heard of it, that need to understand, need to visualize the framework of what we're talking about. We're talking about being the bank. I mean, that's generally easy to understand, but it's a little bit more detailed than that. So maybe if you could lay it out for us.
Yeah, I think really at its heart, and as basic as you can be, it's a paradigm shift, or it's a way of life. It's a way of thinking that's different. Most of the time, when we think, or when people think, they say, "Okay, I need to get a loan for X." They're going to some bank on the corner and saying, "Hey, give me some of your money because I don't have enough, and then I'm going to prove to you that I'm going to pay it back to you." In the process, over your lifetime, you ended up paying massive amounts of interest to someone else.
Mm-hmm.
Well, if people, just your listeners, were to take a minute right now and think about all the interest they've paid to someone else during their lifetime, how big of a number is that? And in the event they could have had that interest in an entity that they owned or controlled instead of giving it to someone else, how much difference would their life be? I mean, that's a lot of money. And so at the heart of it, saying, okay, I want to think and act like the owners of a bank, right?
Mm-hmm.
You go in and you save money at a bank. On their balance sheet, you're entered as a liability. You walk into a bank and borrow money from them, you go on the bank's balance sheet as an asset,
Mm-hmm.
where it's completely opposite for us, right? It's like two sides of paper, but it listed in different columns. And when you start thinking about that, how can my own indebtedness, how can I control that and not be feeding the banking system principal and interest all the time? How do I make it so that I'm paying myself? So let me give you just a rude and small example that I can. Let's say you're going to be your own banker and you have a mason jar and you simply put it on the kitchen table. Well, every bank needs money to loan out. So you
Mm-hmm.
start putting money in that mason jar regularly, whether it's weekly, bi-weekly, monthly, whatever, right? And let's say you get up a certain amount of money, let's call it 28,000, you're going to say, "Okay, I need a new car." Now you could go to the regular bank and borrow from them. You can borrow from the dealership or some other financing company. But what you decide is, no, I'm going to buy this car with the cash in my jar. Yet when you take it out of your jar and pay cash for it, you need to assign a value to that cash. And that's one thing that the infinite banking concept forces you to do, is to assign a value to your cash. Now, if you take all that money out of the jar, what you're going to do is you're going to write an IOU. I owe Kevin $28,000 plus interest, with a monthly payment of say $500 a month for 60 months, right? A 5-year note to pay
Mm-hmm.
back that card. And so you do that, and then you start making those payments back to the jar. When you're done, the jar has the 28,000 plus the growth. It's the exact same thing would happen from a bank. It's just that now it's coming to you instead of someone else.
Yeah. So in that example, just to get clarity here, you would assume that one would have 100% of the cash available to purchase that car, but instead of just going to the dealership and buying it all cash, essentially what you're going to do, you're going to effectively do that, but then you're going to construct a note for whatever the terms might be. Like, we don't need to go down that rabbit hole, but essentially pay back that mason jar on a monthly basis based on terms set forth in that note that you constructed. Is that a
Right.
basic understanding?
Right. Most people, when they do pay cash for something, they do not put a value to their cash.
Hmm.
They shortchange themselves, right? Because we're either going to pay interest or we're going to pass interest on. And when we pay cash, we're passing interest up. And so our future selves says, "Hey, wait a second. I don't have that money and I don't have the growth. Why are you cheating me?" And
Yeah.
so, yeah, you just simply have a note, say, I'm going to pay this back over time. And that's what happens. So,
Yeah.
what you got to build up some sort of equity, some sort of pool of cash, and then you start to use that to finance in the smartest way possible.
And so where
Okay.
does
Back to
oh,
my, go
yeah,
ahead.
go. No, no, go. I was just going to ask, and I think,
I was
but
going to say, well, back to
you're
the
about to
example
go
with my
there.
dad. Well, back
Yeah.
to the example with my dad is his equity in the building was his sweat equity, right? He and his twin brother, they had the lumber from the different business, right? And they were able to get it that way. They could frame, they could sheetrock, they knew how to do a lot of the concrete work. I know that they outsourced some of the plumbing and electrical. They basically put it all there. They had that equity, but now they can use that and basically sold that to someone else and collected the principal and interest.
Mhm.
Same thing with a whole life insurance policy. You're going to build up some equity, which you can kind of look of it as like a line of credit, if you will.
Mhm.
Right. And now you're going to use that to dip into or to loan against to buy anything that you need to buy. I don't care if it's a washer and dryer, a car, a building, a fourplex, whatever it is. So hopefully it's something though that's cash producing.
Okay. So let's talk about whole life insurance. Again, just why that is as the vehicle or the mechanism, I guess you could say, why that be used as a mechanism to facilitate this strategy.
So a couple of reasons. One is there's some tax advantages. Two is there's lots of privacy in that you start to have some money, you don't want to have people coming after you. Three is safety, right? You don't want to have something and have this line of credit and then it go poof. And now you kind of have two loans or you have things crumble, right? You need a foundation, something strong to be able to use, something that has a lot of guarantees. And that's why we use whole life insurance from a mutual company, right? Most of those have been around for 130 plus years. And so they're super solid and you can use it in a way that makes you feel comfortable and go out and acquire lots of real estate. Let me give you a real quick example. So this building I'm sitting in being interviewed in is a two-story office building in downtown Logan, Utah, where I live. When I first came here from San Francisco, I put a significant amount down on this, and then I had a mortgage with Cash Valley Bank, which is just right over here in town. My mortgage was 1996 13, so call it $2,000 a month.
Mhm.
I would send them a check every month from the rents that I get from this building, and they would say, "Yeah, we cashed your check. Here's a little bit of how much principal you have, and a whole bunch of interest." But didn't have access to anything, right? He just cashed my check and sent me a statement back. Fast forward a couple of years, and my wife's looking at the statement and says, "Well, can we access that equity and remodel the kitchen?" I said, "Well, no." We could maybe go and beg them for a C-lock, a commercial line of credit, equity line of
Mhm.
credit, right? And we may get 50% of it. But then I read that book, Nelson Nash's book, and what I understood what could happen is I could then be doing what dad did. I could become the bank on it and own the note. So I put as much as I could, as fast as I could into some policies. Then I took a loan against that. Cash came to me, and then I walked over to Cash Valley Bank and paid them off. The very next month, I wrote out a $2,000 check again. The only difference was who is it paid to. So the tenants and everything, the operation of this building was exactly the same. No one knew the difference. I just sent the check
Mhm.
someplace else. The cool thing is when it hit the insurance company and they cash it, because I'm a part owner of the company, I essentially had access to $2,000 immediately with my signature, no questions asked. So in 1 year, I have access to 24K that I didn't have the year before. Holy smokes, I'm sitting on enough. I can go after a down payment on a duplex. That puts in money the second year, and this building puts in money. See what I'm saying? It started to snowball.
Yeah. Yeah.
That's
Real
what I've been doing.
what's the realistic amount? I guess how can one determine how fast you can fund these policies? I know there's probably some restrictions and some ceilings there of how much you can fund in a given year, and how large, how quick and how large you can get that policy, or in I guess you get multiple policies. But I guess using the example of the property that you're in, the office building that you're in, just maybe get some additional context there so we can kind of associate maybe our own personal situation with that.
Okay, so the amount of death benefit you can get is simply based on your age and your income,
Okay.
nothing else, right? Well, of course, you got to be healthy enough to be insured. But that means then someone that's making a little bit more, they can put a lot more premium or make more contributions or deposits into their policy so they have a higher line of credit faster. My clients will put anywhere between $160 a month and nearly $36,000 a month. I have a
Hmm.
client that puts $440,000 a year in premium. Well, obviously, that's building up a ton of equity right away,
Hmm.
right? And within a few years, like taking massive loans compared to the person that's doing 160 a month. So it's really dependent on, like when you go into the bank and say, I'd like to make a withdrawal from my account, and they said, well, how much have you deposited? Right? It's a very similar here. How much have you deposited? So you can really jumpstart things, put in a lump of cash, call it $250,000, and then put ongoing money after that because it is a life insurance contract, and we need to have it look a little bit like that because the government sort of has a governor on it, a throttle, if you will, that to slow it down on how fast you can put cash in there.
Please explain more. What do you mean by that? As far as like where do those limitations actually come into play? Of how much can be
It's
funded and when it might raise a red flag?
it's the amount of so the premium that you're putting there is it going to build death benefit or is it going to build cash value?
Hmm.
When you do it to build cash value, then you're putting cash that then is off the IRS radar screen. They can't see it, they can't get to it, they don't know anything about it. So the government passed a few laws in the 80s that sort of, and I'm using the word governed, you maybe rented a truck or something like a U-Haul or Ryder truck, right? And it has a governor on the velocity. You can't go over 60 miles an hour or something, right? Whether you put the gas all the way down, something similar to that. So you can't put as cash in there faster than that. Now that is a ratio, not a dollar amount. So the same ratio, if you're putting 10,000 a year, would be similar to the same ratio if you put $100,000 a year, right? It's more the ratio than the like only 9,000 a year. No, it has to do with how much the total premium you're doing.
Gotcha. No, all good. Who is this not for? I mean, like who would not be a good fit today? For a strategy such as this. I mean, like you got to have some money to get started. So I'm assuming someone that's literally got $1,000 in their bank account, they're in the very beginning stages of their wealth creation or just even save general savings of funds, right? Like they're in the very beginning strategy. I'm assuming might not be a good fit for them. Anyone else that comes to mind that this just might not be a good fit for the overall wealth creation strategy?
Well, I believe this is actually the best place to save liquid cash. There isn't a
Okay.
better place to store cash and have like an opportunity fund. So even if they are starting off and things, you do it right, you do it right. The people that are not good for this are the people that don't have discipline. You don't
Hmm.
have any self-discipline, you can get hurt and you can lose money in this system, right? There's that possibility. So it's really, like I said, to start off with, it's more of a mindset and a way of life, if you will. It's what you do. That's the biggest factor in the whole thing. It's not, oh, this insurance company is better than this insurance company, and this design is better than this design. The most important thing is people's behavior. So you got to be disciplined.
Yeah, give me an example. So lack of discipline, where that equates to, someone actually losing money, utilizing this strategy.
Well, the heart of a contract or whole life insurance contract, the insurance company is saying, in exchange for regular deposits or premiums, they're going to guarantee you that your money's going to grow to X dollars when you're at age 100.
Hmm.
In the event that you die before that, they're going to pay a big amount to your beneficiaries. So every time you're doing premium, you're like getting more equity in this future dollars, right?
Hmm.
It's building, kind of like buying a house. House is worth 500,000. Maybe you put 10% down, but each month you're making a mortgage payment and your equities, it's inching up, right? And it gets faster as you get into the process. So at the end, you have the house value. It's all yours. So that's similar here. If you are unable to make premiums, every month or every year, then it collapses. Same thing if you were buying a house, right? And you don't make your mortgage payments, they foreclose on you and you lose all your equity. That's
Mhm.
one way. So that's what I mean by discipline. You've got to be able to make those premiums.
Yep. What's it look like to get started? Speaking with an expert like yourself, I mean, give me an understanding of the initial stage, education for an individual, finding the right, fit for company to work with, such as yourself and your company, but just walk us through step by step what that looks like and how long it takes to get something in place.
First is a yes no question to an insurance company, which is simply an application, right? They're going to look at you from the point of view, are you a risk of early death? If you're in really poor health, they probably won't insure you, right? Because no, remember, for in exchange for a regular set of payments, just like a mortgage payment, right? Um, they can make the money be there. They can know how to make it grow. And so if you live a long time, you make a lot of premiums, there's no risk to them. So someone who's poor health or something, that's the beginning. Do an
Hmm.
application. Now, depending on how much of a death benefit you're applying for, you're probably anywhere from 2 to 8 weeks, just depending. If it's a $500,000 death benefit, it's a lot easier than it's a $25 million death benefit, right? So
Sure.
that's why you say 2 to 8 weeks, and then you're off to the races. You're smart making premiums, and you will have cash values, and then you start determining how you can best use those cash values.
Is there a certain period of time that you have to wait before you can start tapping into those cash values? Is there like a 12-month wall that you have to wait for?
No, not at
Okay.
all.
Okay.
There is value in doing your premiums annually versus monthly. There's like a 5 to 6% value in doing it annually. And so let's
You
say you do
you mean just funding for the entire of the year, 12 months in
right,
advance? Okay.
right. Let's say we do 10,000 for the year instead of $830 a month,
Hmm.
right? So, and when you did that 10,000 for the year, basically, as soon as your funds are good at the insurance company, you should have access between 60 and 75% of that money immediately.
Got it. No, that makes sense. Anything I haven't asked you, Jason? I know that we've only got a short period of time here to cover what is seemingly a fairly large topic, but I mean, just from a general sense, are there any other questions that I should have asked that I didn't that would be important for those that are tuning in?
Um, this One of the things is that this has to do with control,
Hmm.
right? And so there isn't structured payments when you're paying back the loan, right? The premiums are structured, but when you take a loan against it, the payments backs are not structured. So I wrote a little booklet and I want to offer it to all your listeners. We'll put a link where they can go get it and I'll send it to them, either digitally or you can have the hard copy. But in here, I talk about my first foray into a fix and flip, right? And I thought I was cat's meow and I thought I knew what I was doing. I find this great property using a realtor, and then I get a general contractor, gave me a bid, blah, blah, blah. And I thought, yeah, okay. Well, long story is he didn't finish it right. I had to fire him, argued over how much money I'd already paid him, yada, yada, yada. Well, I had taken a loan against my policy as the down payment, right? And then I could take increments out to be paying for things. Now, had I been needing to make payments to someone who had borrowed money from it, whether it was a hard money loan or someone else, had I been needing to make payments every month, I probably would have got foreclosed on. But because I owned the contract and I'm in control, I was able to go a few months, say, oh no, I won't pay this month. Oh, I won't pay this month. And I mean, there was a stretch there. It went several months. And in the end, I lost my shirt, right? The market didn't go as it was planned. After renovation value was not as high as I thought. However, it could have been a lot worse had I not been in control of my payments back and knowing this is when it's going to happen. I mean, think about that. If you have a banker or someone you borrow money from, and they say, "Oh yeah, no problem. You don't need to pay us this month. Just wait till next month." Well,
Yeah.
you can do that when yourself.
Yeah, I could also see where one that's not as disciplined could run some issues with that. 2 or 3 months of no
Right.
payments. You're like, well, that's nice. That's nice not having to make these payments. Well, maybe go 4 or 5, and it just gets a little out of hand. So back to your point, though, you have to be disciplined with the strategy. You just can't use it in a haphazard manner. No, that's fantastic. In your book, Jason, Master Your Millions. Tell us about that and what folks will learn if they grab a copy of it.
So that one is kind of both this booklet and that book is playing off a little bit what Nelson Nash wrote. In his example, he only uses and how you finance the company or finance things you buy, because it's becoming your own banker, and the subtitle is the infinite banking concept.
Hmm.
It's infinite because there's an infinite different ways to use it. I mean, it's nuts how you can all the different ways you can do it. And so he uses two examples. One is just simply financing cars for your family, and the other one is equipment financing. Well, both of those are depreciating assets.
Hmm.
I attempt to take it into an appreciating or a cash producing asset in my books. And I also take a look at why a family needs to set up a family banking system. The Rockefellers have family banking systems. The Hiltons have family banking systems. They buy gobs and gobs of whole life insurance. That's from which they are building their empire, is through those whole life policies, not through Bank of America.
Hmm.
You follow me?
So
Yeah, they'll get very favorable terms from Bank of America, but really at the heart of it, the real center of the whole family entities and everything is whole life insurance.
I'm assuming there's some fairly complex tax planning strategies around having more than one policy, probably more than what we could get
Yes.
into in this show. Fair enough.
Yes, yes.
Okay. Okay.
Fairly complex, and it's also having to do because towards the end of his life, John D. Rockefeller was asked about his success and stuff, and the famous quote is he was asked that by a reporter, and he goes, "Own nothing, control everything,"
There you go. I love that. I love that. Well, Jason, for
and
those that,
that's whole life
yeah,
lets you do it.
for those that want to learn more, I know that you can grab a copy of your book on Amazon, but you've also got a YouTube channel as well. For those that want to learn more, reach out to you, get in contact about this strategy. Where's the best place to track you down?
Probably askjasonh.com. There
Okay.
is a free report there, but then there's also a link in there if you got to dig in through a little bit, but there is a link where you could schedule some time with me one on one. We'll have a
Okay.
discussion, see if we like each other, see if you're going to be disciplined enough to do it. I don't like to bring in people that they're going to come back and be a hassle. That's just not. I don't want to work with that, right? I want
Life is,
people that are going to be
yeah,
disciplined and they're aggressive and they're doing stuff. I'm willing to risk a few minutes and talk to someone that way, but that's the best way.
sure. Okay. AskJasonH.com. Guys, we'll put that in the show notes. And Jason, I appreciate you coming on the show today.
Hey, thanks, Kevin. Is awesome.
All right, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.